Welcome to the debate.
Good to be here.
So we're well into 2026, and the economic dust has more or less settled. But the landscape we're looking at it's just fundamentally different than it was a few years ago. We have this global economy with what the IMF is calling resilient adaptability. Growth is holding at about 3.3%, which is fine. But underneath that, we're in this period of, divergent resilience. Inflation is down to maybe 2.6%, but the cost of living, and I mean shelter specifically, it's just reset at a permanently higher level.
Exactly. And that's what we're calling the Great Housing Reset. And because of that shift, the whole conversation, the one people have around the kitchen table about signing a lease versus a mortgage, it has totally changed. It's not just a lifestyle choice anymore. It's not about the American dream.
No.
It's a workflow optimization problem.
I think that's the perfect way to frame it, a high-cost equilibrium. So the real question for today is this. In an economy like this one, moderate growth, but these sticky, higher living costs, does it make more sense to optimize for stability, which means buying a home to hedge against inflation, or for mobility, renting to stay agile in the job market?
Yeah, it's pure capital allocation. I've been making the case for mobility. I mean, my position is that in 2026, housing has kind of morphed from an asset into a liability that has this massive exit tax. I think that optimizing for liquidity, keeping your capital agile instead of locking it into four walls, that is the superior strategy in a world being reshaped by AI.
And I'll be taking the side of stability, because while the costs are, yes, undeniably higher, I'm going to argue that in this post-2025 world, a fixed-rate mortgage is pretty much the only reliable hedge you have for wealth preservation. It's a mechanism for solvency and for forced savings that you just need in an era where the cost to replace your shelter is only going one way, up.
That's a bold claim, especially given the current numbers, but let's get into it.
Let's start with the elephant in the room, rates. We're seeing 30-year fixed mortgages hovering somewhere between, 6.0 and 6.3%. And I know that gives people sticker shock compared to the early 2020s, but we have to face the reality of 2026. This is the new normal. So my primary argument for buying now is as a defense against that sticky shelter inflation.
But shelter inflation is exactly why renting is winning the math right now.
In the short term, maybe. But let me introduce this idea of debt devaluation. I kind of like to call it the quiet magic of the fixed-rate mortgage. So even with overall inflation cooling to 2.6%, the cost of labor, materials, all the stuff that goes into building a house, that's rising between 3.5 and 6%. So when you lock in a payment in today's dollars, you're freezing your single largest monthly expense. As inflation, even moderate inflation, eats away at the dollar's value over, say, 10 years, the real value of that fixed payment shrinks. Rent, on the other hand, it just resets every single year. We're projecting rent hikes of 2 to 3% annually. That's a treadmill you can't get off of.
Okay, I see the treadmill argument, but let me offer a different perspective on that. You're talking about locking in costs, sure, but you are also locking in capital that could be working much, much harder for you somewhere else. You mentioned the quiet magic of debt, but I want to talk about the loud reality of the monthly spread. Right now, renting the average unit in the U.S. is about $2,200. Buying the median home, that pushes your monthly cash outflow to $2,750. That's a $550 monthly delta.
A delta which goes toward equity.
Well, ideally, yes. But in 2026, that $550 isn't just savings, it's liquidity. I would argue that the opportunity cost of the down payment, plus that monthly difference, is just too high when other liquid assets are outperforming housing. We've just seen a 3-year run in equities that has created this massive wealth effect for anyone who was liquid enough to get in. By tying up $50,000, $60,000, $80,000 in a down payment, plus another $6,600 a year, you're not hedging inflation, you're just suffering from illiquidity.
I'm just not convinced by that, because it rests on the assumption that the average renter actually invests that difference. And that's the classic behavioral economics trap, right? The forced savings of a mortgage, even if home prices stay completely flat, it creates a mechanism where you have to build equity. JP Morgan is predicting prices might stall at 0% growth this year. Even then, the loan's amortization builds wealth that renting just cannot replicate. The renter can invest the difference, but history shows they usually just consume it.
And that brings us right to the core of the friction. You're banking on that long-term amortization, but that requires you to stay put, which leads to my single biggest problem with the stability argument in 2026, the exit tax.
The exit tax?
Yes, we had data for last year from 2025 showing that the average cost just to sell a home, I'm talking agent commissions, repairs, concessions, moving fees, has hit $67,000, $245.
Wow. Okay, that is a significant transaction cost. I'll grant you that.
It is so much more than a transaction cost. It is a wealth destroyer for anyone who isn't staying long term. I mean, if you buy a home today and you need to move for a job in 3, maybe 4 years, that $67,000 cost completely wipes out any equity you might have built from that forced savings you mentioned. In a world of AI and shifting job markets, the ability to relocate without that friction, that is a financial asset. I call it the mobility premium. If you're a homeowner, you're geographically rigid. A renter, you're agile.
That's an interesting point. I would frame the labor market issue differently, though. You're focused on the ability to move to a job. I'm focused on having the right infrastructure to do the job from where you are. We're seeing this remote work wage premium dynamic play out. For the bottom decile of earners, yeah, they need about a 10 to 15% wage premium to afford enough space to work from home. But high-income earners, the top decile, they don't get that premium.
Because they're just expected to have the space already?
Precisely. Buying allows you to modify your infrastructure, build a real home office, an ADU, a dedicated deep work zone. You can't just retrofit a rental to do that without, risking your entire security deposit. Stability lets you optimize your environment for productivity, which in turn protects your income.
But look at the return to office mandates. 75% of workers now have some kind of RTO mandate. The whole digital nomad dream is, well, it's fading for a lot of corporate jobs. So if you buy a house in a so-called Zoom town like Cleveland because it's affordable, and then your boss demands you be in a hub city 3 days a week, you're stuck. That's the asset location mismatch. You have to pay the $67,000 exit tax to move. The renter just waits out their lease.
I'd argue the Zoomtown phenomenon actually supports buying. I mean, markets like St. Louis or Minneapolis are where the math still works. The superstar cities might have an exit tax problem because prices are astronomical. But in those secondary markets, buying provides a hedge against the very instability you're talking about. If you lose that remote job, at least you have a fixed cost of living that's probably lower than the rising rents back in the hub.
I see it differently. I see those as potential traps if the local economy can't keep up. But let's shift to the supply side for a second. We can't ignore that 2025 saw 500,000 multifamily units delivered. Vacancy rates are sitting at 7.2%. We are in a period of what I call concession saturation.
You mean things like a month of free rent, free parking?
Exactly that. Landlords are literally subsidizing your living costs just to fill these new units. So why would you take on a 6% mortgage and all the maintenance risk when institutional landlords are desperate for tenants? They are offering months of free rent, upgraded amenities. You can upgrade your lifestyle and lower your costs at the same time.
That is a very compelling point for this specific moment in time. I agree. But you're looking at a temporary supply glut. Construction materials, labor costs, they are all still elevated and facing upward pressure. New supply is going to slow to a crawl. And when that glut gets absorbed, rents are going to spike again. Buying sets a floor under that risk.
But when does that happen? That's the gamble. And speaking of floors, we have to talk about real versus nominal value. Most forecasts, including from JP Morgan, suggest nominal home prices might be flat 0, maybe 1% growth. But inflation is 2.6%. That means, in real terms, housing values are actually declining.
I acknowledge that. Look, real estate is not a get-rich-quick scheme in 2026. But let's go back to the inflation experience data. Research shows that people who have lived through high inflation, which we all just did, are statistically way more likely to buy because they understand that holding cash is a losing game. A hard asset like a home provides a hedge. Even if real prices dip this year, the replacement cost of that home, it's still rising.
I'm sorry, I just don't buy that the inflation hedge argument justifies the cost of carry right now. You mentioned maintenance earlier. That is not a small number. We are seeing average maintenance costs on a single-family home now exceed $6,000 a year. Plus, insurance premiums in coastal areas they're surging, sometimes doubling. As a renter, my maintenance cost is zero. My insurance risk is minimal. That $6,000 is another major hit to your so-called forced savings.
It is a cost, yes, but it's also an investment in the asset. And you're leaving out the tax code, the mortgage interest deduction on loans up to $750,000. It acts as a huge subsidy, especially at these 6% rates. The government is essentially giving you a discount on your interest. Renters get zero tax benefit.
The standard deduction is so high now that fewer and fewer people are itemizing, so that benefit is a lot narrower than it used to be. But let's get to the timeline. This is the crucial variable in our whole algorithm.
The break-even horizon.
Exactly. Historically, the rent versus buy break-even was what, 3 to 5 years? Stay 5 years, you win. In 2026, the data shows that horizon has stretched to 5 to 7 years in most markets. In the Bay Area, it's 8 years.
That is accurate, yes.
So for anyone with a 2 to 4 year horizon, which is a huge chunk of the modern workforce, buying it's mathematically irrational. You are almost guaranteed to lose money once you factor in the closing costs, the maintenance, and that giant exit tax.
I accept the longer horizon. In fact, I embrace it. That's exactly why I talk about stability. Buying in 2026 is a commitment. It's a commitment to a location. But I do want to pivot back to the wealth effect. You said renters can invest the difference, but let's look at the wealth accumulation timeline. Even with a longer break-even, the return on equity for a homeowner is leveraged.
Explain what you mean by that.
Okay, so if you put 20% down, you have 5-to-1 leverage. If the home appreciates just 2%, which is below inflation, I'll grant you, that's a 10% return on your cash investment. A renter cannot get 5-to-1 leverage on their stock portfolio without taking on enormous margin risk. The homeowner gets that leverage safely, subsidized by a 30-year fixed mortgage.
Safely? I'd argue that leverage cuts both ways. If prices drop 5%, you've just lost 25% of your equity. And frankly, in the K-shaped economy we're in, where the bottom is struggling and the top is thriving, that leverage is incredibly dangerous for anyone who isn't already solvent.
And that's why this is a solvency discussion. But look at the alternatives. In a place like Singapore, you have the HDB model, 80% public housing. It creates stability. In the US, we have the individualist model. We don't have that safety net. American workers must build their own equity safety net. And owning your own shelter is the only real way to remove the variable of a landlord from your retirement equation.
That is a very, very long-term view. But we are living in a short-term, volatile world. The mobility premium is all about optionality. If I rent, I can move to a cheaper city, I can move for a better job, I can upgrade my apartment without paying a realtor a dime. In 2026, with the supply glut, I can negotiate. You can't negotiate with your 30-year mortgage once you've signed it.
You can refinance.
If rates drop, and the forecast is for rates to stay pretty much where they are, betting on a refinance is just speculation.
It's an option, though. And let's not ignore the psychological value of stability. This stability algorithm isn't just about the numbers. It's about immunity from the renoviction, immunity from a landlord selling the building out from under you. In a world of AI disruption and economic uncertainty, knowing your shelter cost is fixed for 30 years, that is a powerful mental asset.
I agree there's a psychological value, but it's an expensive one. And I'd argue there is just as much psychological value in liquidity. Knowing I have $50,000 in the bank and an extra $550 a month in cash flow helps me sleep a lot better than having a house I can't sell without losing 10% of its value on the way out the door.
I think we're really converging on the central tension here. It all comes down to how you view the future of the dollar versus the future of your career.
I agree. So let me just summarize the case for mobility. Buying a house in 2026 requires you to be what I'd call an informed, stable actor. You have to know with a high degree of certainty that you're staying put for 7 years or more. If you're a strategic mobile worker, someone building a career, adapting to new tech, maybe unsure of your long-term geography, the math overwhelmingly favors renting. You exploit the supply glut, you avoid that $67,000 friction cost, and you keep your capital liquid.
Settling down too early is a major risk to your career agility.
And I see why you prioritize that agility. I really do. But my summary for stability is this. Renting is a valid short-term tactic, absolutely. But it is a poor long-term strategy. We are living in a world of permanently higher costs. This great housing reset is not going to reverse itself. Locking in your single largest expense, your shelter, with a fixed mortgage is the only way to get off the inflation treadmill. It converts a liability into an asset, it provides tax benefits, and it forces you to save. It's the difference between simple liquidity and true long-term solvency.
It's fascinating, isn't it? How the same set of data can support both views, and it all just hinges on that one variable: time.
Precisely. The decision is no longer about the emotional American dream versus throwing money away on rent. It has become a pure algorithmic choice.
Liquidity versus solvency.
We'd encourage everyone listening to run their own total cost of housing equation, look at that break-even horizon in your market. If it's under 5 years, you should probably listen to the dissenter.
And if it's over 7, you should probably listen to the advocate.
Thank you for listening to The Debate.